Good afternoon, traders. This is Chris Buss with Traders Profit Compass with your Weekend Profit Navigator for August 1st, 2021. Okay, I hope you guys are having a nice weekend. What I want to do today is we had a lot of events last week. I want to review those. I'm going to go through market internals, look at the indexes, find out where we're at, review all our sector ETFs because there have been some developments. Of course, I'll point out a few trade ideas to start the week and then give a look ahead. So, as always, don't excuse me. Don't forget to run this video at 1.25x. I don't think you'll miss a thing, and it'll increase your efficiency. So let's just talk. I've written down some notes from last week just to recap all the stuff that has happened. We had all the market leading fat man names report over the last week and a half, and we know from our daily videos that this has been a fat man driven market. That is, the Facebooks, Apple, Microsoft, Amazon, Google, those names have been driving the indexes higher over the last at least 60 days, if not 10 weeks. All those guys have blowout earnings, and except for Google, really all of them had soggy results. Some of them sold off a lot, like Amazon. Some of them were just, I would characterize as soggy and digesting the big move into earnings. So that is something we're definitely going to have to watch. We had a big FOMC announcement on Wednesday, and believe it or not, Jay Powell found a way to be even more dovish than ever. Some people were thinking he might, with inflation ripping, that he might start thinking about rate increases, but no, he's not even on the table. So he remains quite dovish, and I think really with the signaling that he was giving, I think it's going to be September or even later, depending on how this COVID variant works out, that they may start signaling when they might want to start a taper process. I don't think it's going to be at Jackson Hole. I think that's just the time for him, to give a speech, and he's going to talk about the inequality and employment and all that kind of stuff. I don't think it's going to be a place. And oh, by the way, we're going to start tapering in January. I don't see that happening. So I think we've got another 60 days of status quo out of the Fed. We had a GDP miss. A lot of people were looking for 8.5%. We only came in at 6.5%. We saw real rates crater down to minus 1.2%. And remember, the real rates are the nominal rates, the rates of the real rates minus the inflation-adjusted TIPS rate. So that is reaching towards new lows down at minus 1.2%. We also saw a head fake in the 10-year yield that popped up a little bit and then rolled right back over hard on Thursday and Friday. We had a head fake out of IWM. I thought small caps were making a move, and it rolled over hard at the end of the week, kind of dashing those hopes for now. We did see gold get off the mat with an impulsive move, kind of digested at the end of the week, but still making a positive move. We saw materials with a big breakout, and that is a cyclical sector that we have been watching. We got the breakout, but that was the only one. So I'm not quite sure why that would be the only one making a move, whether it's tied to the infrastructure bill that's grinding around in Congress or what the particular reason is. But though that particular ETF and some of the industry groups within it made real positive moves. And then lastly, we've got the equal weight SPY trying to break out, which would be a major development. We are right there on the cusp of that. So that's something that we want to look at. So let's dive into the charts. I know most of us aren't big currency traders, but there's an adage in trading that if you get the dollar right, a lot of things are going to fall into line for you, because there are these scenarios that we've been operating in. Scenario one, where we've had falling yields and a rising to stable dollar, and here where we had a rising dollar and we've had stable or falling yields, and that's been very supportive of the fat man complex and the bubble space and all the high valuation names. But now we're starting to see the dollar roll over. In fact, this week we made a break below this support level, came down, sliced through the 200, bounced off the 50, and closed right at either support or resistance, depending on how fine a line you want to draw there. But the thing I'm going to be watching for this week is, was this just a correction within an uptrend, or was this the correction? Was this the reflexive bounce, and now it's going to start rolling back over again? Because that's going to have a big bearing on the things that we're looking for in a market shift. And what do I mean by that is, if we've got a falling dollar, so if this rolls over, that's going to be very supportive of the commodity complex and, materials that have already broken out, probably as a result of this move here. And then if yields pick up a little bit, then it could be game on for financials, industrials, cyclicals, and the reopening trade. We just haven't seen that yet. But so this may be a pivotal week as far as the dollar goes, because we're right here. It either bounces up and then it's back above support, or it loses the 50, and then it would be not a lot of support down here for a continued move south. So I'm going to be watching for that really closely, and I suggest you do too. Interesting moves in rates. It seems like our market has been so rate dependent, rate driven the last, really since November, when we saw the rate rip, and then we've seen them roll over since. And we've had a lot of head fakes. We've been in this down channel, and just from a technical study, we've come down to the channel, we bounce up to the top, we roll down, we bounce back up to the top, we come down. This downtrend line has served as solid resistance, and then we rally, which has provided a lot of head fakes. In cyclicals, you see this rate rally and everybody piles into cyclicals, and then they roll it over, and then the head fake ensues, and then they sell the cyclicals off again. We resisted this head fake here. This one here, because of the move in materials, I personally took small positions in Freeport and Vale, an iron ore producer. Those turned out to be wrong so far. And, so we'll see. But it goes to show the power of the technicals. I mean, you can say whatever you want to say. Rates shouldn't be this low with inflation ripping, and you're familiar with all those narratives. But look at how well the down channel has contained rates. And I mean, from a technical standpoint, it's doing everything you want to see in a good, it's behaving to the technicals well. It back tests resistance, then it rolls over, then it back tests the downtrend line and it rolls over. So until we see, signs that it can break this down channel, I think you have to kind of assume that rates are pinned down here. So that's something to watch. And I think right here is potentially a nice trade setup. Why? Because this has been the falling rates. TLT trades opposite to rates. So while rates are falling, TLT is rising, but now we've got an ascending wedge here that's getting really tight between 150 as resistance, and we've got a rising trend line here at 148. So if rates roll over or continue to go down, you're going to get a breakout in TLT. And I think if you alarm 150 and you get that breakout, you can go long and look for these prior highs at 152.71. And if they roll over even further, then you got a shot at 155. So I would be watching for that. And, while you're setting alarms, you might as well set the downside, because there's going to be a technical sell signal on TLT if we break this uptrend line. So if you get a move down below 148, your next level of support is going to be the 200 at 146, and then the 50 at 145. So either way, I think there's going to be potentially like a $2.50 move in TLT, whichever way this thing breaks. So if you're any kind of a person that wants to trade TLT, I think those are the key levels. And I mean, even if you're not, I would alarm those levels, because it's going to have a major impact on cyclicals and where the market turn may be. Also, we've been watching and keying off of the number of stocks above their 50-day moving average, and you can see that we are still pinned down in the mid 40s. So another way to say that is 55% of stocks are below their 50-day moving average. And there's an adage in technical analysis, nothing good happens below the 50, right? It's kind of the demarcation line for uptrend versus either soggy or downtrend. And the majority of people that have had diversified type holdings have had a rough couple of months here, as we've gone from 75% of stocks over their 50 to now 45%. So those people have been hurting. And I think we see that reflect. I'm going to show you a market sentiment thing here. But the thing to watch here is, on our individual charts, we look for breaks above the 50 as a place to get interested. And so if we saw a break above 50% in the aggregate of stocks, that would mean that more than 50% of the stocks in the market are breaking above their 50. And that would be a bullish development and a sign that things are healing under the surface. So I think that's going to be important. This is the New York highs minus lows. And you can see that, we've been struggling the last couple of months here as new highs minus new lows fades. And now we're trying to get an uptick here. So if we see that the new highs minus new lows is rising, that will be a good sign, again, of further healing underneath the surface. A lot of cross currents. Here's one to make note of. This is the ratio chart of high beta stocks versus low volatility stocks. And when this ratio is rising, it shows that risk appetite is rising because the high beta stocks are outperforming the low volatility stocks. And that's the market that we had from November up until June, the beginning of June, where it peaked. And since then, we've seen this rollover where the high beta names have underperformed the low volatility names, and that is a defensive type characteristic. Now, the odd thing, or the confounding and frustrating thing for most traders and investors is that this move here has not affected the indexes. Why? Because it's been fat man driven. And so those top 5 or 6 names have been holding up the indexes. So while the average trader or investor has been feeling this pain at the index level, we haven't seen that pain. So one of the things in August are going to be watching for the following. Do the fat man names finally succumb and roll over and catch down to the average stock? And what I mean by that is, if you only got 5 names holding up the indexes and they roll over, then obviously the indexes are going to fall and come more in line towards the average stock. So if the indexes roll over and then make that dive towards the 50 EMA, that would put it more in line with the average stock of the NYSE, which we just talked about. Or does this break out and roll up higher, showing that people are piling back into the higher beta names and having that break higher? And that would be an indication that there's healing under the surface. Here's just another way to look at kind of the same thing. This is the momentum factor ratio chart against the value factor. And so if this ratio is rising, the momentum factor is in control in the place you want to be. When the ratio rolls over, that's when value is outperforming. So in 2020, it was momentum. In November, we saw that rotation into cyclicals and value. So this ratio falls. And so now for the last, couple of months, there's been an impulse to turn this around, but we're still below the 200. What you want to see if it doesn't really matter if you're a bull, it's just where do you want to be? And so during this part here, that's telling you that people have moved away from the cyclicals, and we've seen that. That's what we've been watching. That's what we've been talking about for the last 2 months, that the cyclical trade died, and now there's been a move back towards momentum. And I was talking about sentiment. We've had this on our radar for a while. We're down, at least by this sentiment gauge. We're in extreme fear, right? With the market or the indexes at all-time highs. And what you're seeing there is a reflection of what people hold. I mean, if people are holding a bunch of winners, they're going to be over here in the greed side. If they're holding a bunch of losers, they're going to be in the fearful side because they're feeling that pain. And I don't have the answer, but I kind of think that for there to be a massive rug pull, that would validate these people's sentiment. And that's usually not the way it works. Usually they get everybody bullish and then pull the rug, or they get everybody bearish and then rip it while people are bearish. I mean, that's just kind of the way it works. So this is a contrarian bull signal. We'll have to see how it plays out, but I think this is a check mark for the bulls as far as that sentiment reading goes. Here's the equal weight SPY. We've been watching this range between 146 and 152, and we're above 152. We're 152.70 and trying to recapture this uptrend line. And you can see here that momentum has reset down at the zero line and starting to inch up. And here on RSI, we've broken above the downtrend line. And so we've had, let's see, we've had 3 months of consolidation in the equal weight SPY, and now we're emerging above. And I think if it can be a little bit more assertive and drive a little higher and secure that breakout, that would be a hugely bullish sign, because it's an indication that the average stock is doing better, because in this index, of course, Apple and Amazon and Facebook are no different than any other stock. They're all equal weighted. So this would be a nice indication that other stocks are starting to participate. Here's the daily chart of SPY. You'll recall a couple weeks ago we had the world is ending scare with a tag of the 50. But what we were saying was that if you go back in time, whether it's here, and here, all those times were times to buy at the 50, not sell. So we've had a fantastic couple of weeks, because instead of, we were exiting our shorts if we had any, but also turning bullish at the 50, and we got a nice big bounce. But so as it stands now, we're sitting on the 8-day. We're above the 8 and 20. Well above the 50. So, I mean, as far as next week, nothing bad can really happen above 436. We can get, frustrated or whatever, that it might not be moving higher. Maybe it consolidates for a while. But as long as it stays above, 436, everything, nothing bad can happen. Now we've got the 20 EMA is at 434.75. I think even a move down to there at, let's just call it 435, I don't think is the end of the world. I mean, if you lose the 20, as we've discussed and as we operate, you've got to get very tactical and defensive there. If we were to roll over and lose the 20, then you've got to take appropriate action in your portfolio and your active trading to mitigate any potential downside, because you could see a move down here to the 50 at 427 very, very easily, and then we would have to reassess if that's a time to buy, or if we break it, then it could be game on for a further downdraft. And while we're talking about that, I think it's important to recognize that the period between August and October has seen more than its fair share of rug pulls through the years. And as we look out into August, super low liquidity, but bizarre things can happen in August. And if there was ever a time to say, you know what, the kids are going back to school in a month, and time to reconnect with the family, time to recharge my batteries as a trader, go off and do something fun for a week or two or a month, whatever, August is the time to do it. It's a time to be cognizant of the fact that liquidity is going to be at the lows. I mean, all the traders, the Wall Street traders, they're all going to be on vacation. There's not going to be anybody home. So there's the possibility in this low liquidity environment that there could be some, added volatility, and, I'll just say bizarre things could happen, kind of thing, where, and we've seen it before in August and into September and certainly in October. So this could be a rough seasonal patch as far as, just during the year. So we've got to be aware of that. And I don't think that's a wholesale reason to sell. It's just something to be aware of. And since we drive everything off of the levels, the place to have your antenna really go up is if we were to lose the 20 here at 427.50. Qs. I mean, it's pretty remarkable if you think about it. Even with all the turbulence with the fat man names and all that, we're above the 8-day, we're above the 20, we're above the midpoint of the channel. We're right at all-time highs. So it's hard to get bearish. Now we've got bearish divergences. We're near the highs, but we're rolling over on momentum and rolling over on RSI. But that's not a reason to sell. It's a reason to keep your antenna up, keep your head on a swivel. But as long as you're above the 8 and the 20-day, how can you really get bearish? You can't. You've got to you got to stick with the trend. And right now the trend is up. And I always like to, when I sit back, especially on weekends or, quiet time, think about what would the pain trade be from here? What's the positioning like? What would the pain trade be? So we've got this whole group of people that have been suffering with the quote average stock. We just talked about it below the 50-day moving average. What if the fat man names just ripped from here? I think we talked about, it's going to take some time for Amazon to heal, and after the earnings and they sold off a little bit. What happens if those are just bought up immediately and they start ripping, and the average Joe trader is locked out yet again with the averages running when everybody's thinking about, August is a perfect time for a pullback, and the average trader sitting in names that aren't working, and people reluctant after these earnings, reluctant to buy. It seems like the pain trade might be for all those fat man names to just rip. I'm not saying that's going to happen. I'm saying that seems to me to be the pain trade. And, a place to get defensive, just like we talked about on SPY, would be, if these bearish divergences play out and you roll over here and you roll over and lose the 8 and the 20, and then you lose the midpoint of this channel at about 360, that's when I would start getting to be very tactically defensive and probably, be concerned or lighten up on my longs at that point, and then see if it can recapture the 20 and then get back on track, or if it's going to roll over to the 50 and then possibly down towards the bottom of this channel at 340. But if it got that far, that's of course a bazooka level. If it were to roll over and come down to the bottom of this channel, where we can see that back in time, had you bought the bottom of that channel, that's a very high risk reward trade to try and get long right there. So we'll have to see how that works. IWM, really frustrating. We had a head fake here on Thursday. We broke above the midpoint of this range. We broke above the 50, and then they faded it. They got Chris here on a head fake, and they came back down. I still think the important line as traders, as technicians, we can identify the important levels. What we can't predict or we can't know is if a breakout sticks, if it's a head fake or if it's real. I think you have to take the signals and then react if they ended up fading that breakout, which is what they did. So I got long, and then they faded it, came back below this 222, and so now I'm out, and now I got to wait for another breakout. But IWM has been really frustrating. It hasn't done anything, and I think until the reflation trade and the reopening trade kick back in and rates start to make a little rise, I think you're going to have trouble, or IWM is going to have trouble getting real traction. So let's switch gears and look at some commodities. Here's the CRB Commodity Index. It just keeps grinding higher. I mean, everybody wants to talk about, oh, you see lumber, it rolled over, it went to 2,000, and now it's 600. I told you it was all transitory, blah, blah, blah. And yet the commodity index, I looked back from this point here, April 1st, there's only been 4 red candles on the weekly since April 1st. So that's April, May, June, July. 4 months, you've had 4 red candles, 4 out of 16 with this drive higher. So I'm still bullish on commodities. I'm still bullish on oil. We had the 3 or 4 day scare. They bought that right back up. So now if you wanted to mark something on your chart, mark 51 on USO, and you've got a uptrend line here also to shoot against. You get a breakout above 51 on USO. I mean, I think you got to buy it on that breakout. Could PPO and RSI be a little stronger? Yeah, but you got to trust price, and if it breaks out, then you want to be on board that trade. And it's just been so resilient, even after this drawdown, and they just bought it right back up. And I think the bulls still are in control. Here is coffee, which we lost track of, but it just is indicative of the commodity complex in general, and is also a good lesson to those of you that do not often trade commodities, that just how fast things can move. We had participated in here, got frustrated, closed out some winners in here, lost track of it, and then there was just an explosion over the not last week. Last week was corrective, but the week before that went from 44 to 55 in 1 week. And so if you had been paying attention when price dropped back below this 44 and then broke above, that was your key to get back long again. Or if you were in this trade for the long run, you were never stopped out. And then, so now my point of showing this chart also is we've had the corrective action and we've pulled back in to the 4-year high. This was the 2015 high back here at 50. And so we broke out, we came up to 58, and now we're back at 50. That would be a really nice technical line to shoot against, to watch next week on Monday. Yeah, I know these things are gappy and they move fast, but if it can hold 50, then you might see new highs. It's definitely a technical spot of importance here at 50, and I would be watching that really, really close. We had a move in gold off of the mat. We came up here to 171, and then Friday it pulled back. For my money, alarm 171. If you get a break above that, you got 174 as your target. And if there's any kind of momentum and follow through, you can look for 176 and possibly get on up to 179. Or if you want to be a little bit more aggressive, you can shoot against the 50 here at, let's just call it 169.50. Buy it right here and see if you can get that breakout of 171. What I'm going to do is I'm going to wait. I'm going to wait for 171 for price to take out 171, then get involved and try and get on board for a bigger move. Same kind of thing with the gold miners. It gapped higher, which is this gap here. We've got an existing gap from before. We've got the 50 and the 200 in between. So what I said on Thursday and Friday, I don't want to particularly get involved in here, even though I am bullish. I don't want to get trapped under 35.75. I don't want to get trapped under the 200 or the 50. We could get a pullback into 34. That would be a place if this gap filled and you got a pullback into 34. I think that would be an interesting place to take a shot, even for a potential bounce into 36. That would be a nice winning trade, but not right here. Not right here. I would be watching this for a pullback into 34 or a breakout above 36. And I think if you got a breakout above 36, you would have gold above 171, and then you got a chance for a move up into the 39s. So I like alarming those levels, either 35.75 and 34.25. So at either one of those levels, I would be interested in a long on GDX. Silver is trying to break this downtrend line, wrestling here with the 200. I'm not gonna play via silver, but if I were, you could take a shot right here against the 200 and see if you can get that breakout and move up through the 50 and up towards 24.60. And if you take that out, you see you've got a gap here that I didn't mark. You've got a gap, it's a dollar wide right here that you can try and fill, and then a move back up to the top. But just remember, that's linkage back to the US dollar. We've seen the dollar weaken, and as long as the dollar keeps weakening, that's going to be a tailwind for precious metals. So that's one of those other reasons why you want to watch the dollar if you're into precious metals. One thing that I found really, really encouraging this past week is the strength of semis, and it's widely regarded as a cyclical sector, and it's regarded as a risk-on, risk-off sentiment indicator. And we had a real nice week. We've wrestled with these fake breakouts that we've talked about, but now we've broken above this 262 level, and as it goes with technical analysis, you get the breakout. You've got to take it. You can't be thinking, oh, well, it's just going to be a fake out like these other ones, and it's just going to roll over, and then you're going to be disappointed again. After being disappointed here and here and here, kind of give up on the trade. And then the time you give up on it is the time that it goes. So I got long on Friday. What am I? I think I'm out in August. 267. 267 and a half calls. So what I'm hoping is that it can hold this breakout at 262 and then drive higher. But if that's the case, that's going to bode really well for tech and the high beta trade in general to see that drive higher. And one of the things that we've either been lucky or good on is AMD. And you can see here that we had a monster weekly breakout that a lot of us captured this week on the daily. AMD has been consolidating for over a year between 75 and 95. And now we got the impulsive breakout that targets at a minimum a move to 115 on a measured move basis. And usually what you see is when you've got a year-long consolidation like this and you get that impulsive breakout, not a peekaboo, 50 cents over, not 95.50, but we took that out convincingly. And so what I'd like to think is that we drive north from here. If you missed it, I would still follow it closely, and I'm not hoping for this, but if it happens, it happens. If you get a back test of 95 on the weekly or 98 on the daily, you buy it, because that would be the breakout, back test, and go. Very common technical move. So I would, if you're new to the channel and you haven't had AMD on your list, put it on your list and keep an eye on it. Now, I want to do a quick run through of our sector ETFs. Materials, big breakout, taking out all the moving averages, taking out this trading range, and now targeting 85 and a half. Big impulsive move. But as we look at the other cyclical sectors, like energy and financials and industrials, we're not going to see the same thing. So here we've got XLE Energy was down 1.5% on Friday. Of course, that was ExxonMobil and Chevron getting dwarfed on their earnings, and that's over 25% of this index. So if Chevron and Exxon are not working, XLE is not going to work. But the interesting thing is, here's XOP, which is the Exploration Production ETF. We just talked about oil about to break out to new highs, and this looks more like a bear flag than anything else. So the equities have not been participating in the energy sector, and you'd like to see equities follow the commodity, but at this point we haven't seen it yet. But I would certainly be watching that very, very closely, because if oil takes off, I gotta assume at some point that the equities would follow. Here's XLF. We've talked about this congestion here. We've talked about this level at 36.75. Keep watching it. That's all you can do. If rates rise, you're going to get a breakout. And so keep that level in the crosshairs. Personally, I like, if I'm going to get involved in financials, it's going to be with the regional banks. Why? It's more of a direct play on rates than the big banks. If you look at XLF, it's got insurance companies, and it's got big banks. It's got all kind of different financial credit card companies, all kind of stuff in there. And it's not quite as direct a play on rates as the regional banks. Those big banks have, all their trading income and stuff like that. So I like to focus on regional banks, and you can see that they just haven't performed. And so they're still below the 50, still below this 64 level. So I've got an alarm at 64, not necessarily to, oh my God, I got to buy it there. But I want to watch and see if we get a trend line breakout there that can challenge the 50. And then if we get a break above the 50, then we've got a legitimate reason to sit up in our seats a little bit more and pay attention. But you can see RSI below 50, PPO dead in the water. So not a lot happening in regional banks right now. Industrials. Keep an alarm on 104. If you get a breakout above 104, it should be game on and a good sign for cyclicals. If you break out above 104, then you can challenge up towards 105.50 and 106 at the prior highs. But I think more importantly, it would be a further validation that more of the cyclicals are perking up. Tech, right near the highs. I don't think there's anything to particularly do here. You're either, you can, just be long here above the 8 and 20 day. If you get a breakout above 154, you can buy it. You probably already in it. I think we were talking about this down here on the break above 143. So whether you're in the ETF, trading the basket, or the individual fat man names, that's just personal preference at that point. If mega cap tech is working, this XLK will be working as well. XLP, defensive sector, that shows that low volatility trade that we talked about. That's been working the last couple of months here. And so while it's nothing to trade, you can always watch those defensive sectors and see how they're doing. And if you see defensive sectors roll over and the offensive sectors take charge, that's a hint in and of itself that people have more risk appetite. And so here's XLV. We're in this trade. We got this breakout here at 125, and we've rolled up a couple times. Stay long. No reason not to be in this trade with price well above the 8 and 20 day, above the trend line. Stay long. XLY has been more volatile because of Amazon and it's more of a high risk sector, but still back here towards the highs. And if you got a breakout above 186, taking out this trend line, taking out the prior high, I think you can be long. I wanted to hit a couple of these materials names just to illustrate what's going on. Here's Alcoa, aluminum name, obviously. Big uptrend, some corrective action, and now this week breaking out above, right at 40, up 8% this week. And we've got the prior high here around 43, so that one's breaking out. We've got Century Aluminum, same deal. Two and a half months of corrective activity, now with a big impulsive breakout. I think you get a move above 15, you can be long and then look for 19 and a half. So aluminum is really perking up. Here's Freeport, which is copper and gold mining. Came down here to 31 on the 200, having 2.5 months of consolidation. Now back up here at 38. You get a breakout here. I think you got a shot at 41 and potentially 44. I am long with August 38 calls. So obviously I'm hoping that Freeport takes off. And I like the fact that you've got the fast moving averages turning up pretty sharply with price above all the moving averages. And I always like to see that, especially when price recaptures the 50-day moving average. Here's a steel name, Steel Dynamics. Been consolidating between 58 and 66, and now making a run at the top of the box. You get a box breakout at 66. That would target an $8 move, so that would target 74 on the upside on a measured move basis. So I would be setting yourself an alarm at 66, and also make sure you always check your earnings dates before you take a position. And if it's right around the corner, I wouldn't do it. I would wait for that to clear, then re-engage the stock, because earnings are always a wild card. Here's Nutrien, specialty chemical / fertilizer company. We had a peak, and then we've had that corrective activity that we talked about, but now it's challenging, breaking that downtrend line. We're above all the moving averages. So I think if you could set an alarm right here at, say, 60, 61 area, and you get that breakout, I think you can make a run, or a case for a run, up towards the prior high at 65. So another materials name that you can watch. But you can go through your list, go through the specialty chemicals, go through the commodity chemicals, the non-ferrous metals, which are like copper, Freeport, Southern Copper. Let's see, what else? Aluminum. And I'm not saying you got to load up on all of them. You could take your shots, but that's the one cyclical sector that's working for whatever reason. So that's where I would focus your efforts. And if the rest of the cyclicals, like the industrials, energy, banks break out, materials may be the leading sector of that breakout. And just one last chart, big breakout in home builders this week, right up here, before just checking back on Friday. Why don't you set an alarm at 72, and then if you get that breakout there at 72, I mean, you can see double bottom breakout. And so on a measured move basis, let's see, what is that? 71 to 66. That's a $5 move onto 71. That would target 74 at a minimum on a breakout. But I mean, at 74, I think you're probably going to go back and tag that prior high at 77 before there would be a real sticking spot. So I would alarm 72 for next week and beyond if home builders were to break out. So that's all I have in charts. But let's talk about next week and August in general. I'm gonna be watching that NYA 50R really closely. The number of stocks above their 50. I'm going to be watching the U.S. dollar to see if the breakdown continues. If it does, that's going to juice precious metals. I'm going to be watching rates and TLT really closely. We talked about 148 on the downside and 150 on the upside as alarm levels on TLT. And I'm going to obviously be watching the Fat Man to see if they buy it up or if it remains soggy or even sells off next week. That's going to be critical. And then signs of a reflation trade for heading into August. So I know it's a long video, but a lot of content. Like I say, be careful out there during August. And if you've made a killing so far this year, or are doing really well, or just want to, look for a time to recharge your batteries, I think it's going to be an energetic fall. And, if there were a time to step aside, it would be, between now and Labor Day. And, if you were looking to take some time off, I would do it now versus, in November or something like that. But anyways, I think it's going to be exciting here in the next few weeks, and I'm going to be looking for signs of that market turn. Or we'll just stick in Fat Man, and if it wants to rip, we're going to be there because we've spent a lot of time and have focused on it, and we know our levels. So let's wrap it up there. If you're new to the channel, thank you so much for stopping by. I hope you found the content worth your time. If so, hit the subscribe button and the alarm bell. You get all my content going forward. And over in the show notes, you can do yourself a favor by clicking the link, and then you can drop your email in at the website, and then you'll get all my content delivered right to your email box and join our community. You'll get an invite to our trading room. A lot of new folks have joined lately. It's great to have more diverse group of traders. A lot of good traders. A lot of good women as well trading with a lot of good ideas. Everybody's real generous with their time and with their idea flow, which is great. And so longtime listeners, thank you for the support, and thank you for passing my link along to other traders in your circle and your social media outlets. It's helping me build the channel and building my viewership, which I really appreciate. So this has been Chris Buss with Traders Profit Compass. Enjoy the balance of your weekend, and we'll hit it hard tomorrow morning. I will talk to you then.